Central African Republic plans to leverage Bitcoin as a reserve asset. Kenya's debt stock to China shot up by 10.8 billion shillings in May, the fastest month-on-month growth since January. Plus, Zimbabwe's central bank officials plan to meet retailers on Tuesday for price hikes. Great to have you join us on the program. I'm Ladi Williams. First off, let's take a look at how your money is performing at intraday. We'll begin with market numbers from Africa, which are all green today. South Africa's GSE index gained about 2.68% at intraday, while Nigeria's NGX all-share index advanced by 0.27%. Elsewhere in the continent, the EGX 30 jumped by 1.65%. Meanwhile, Kenya's index is still closed. And it's a similar picture for markets in the Middle East, where all the indexes there we track are traded in green territory. In the United Arab Emirates, the Abu Dhabi index was up 0.11%, while the Dubai index was higher by 0.34%. Elsewhere in the region, Saudi Arabia's market index climbed 1.58%, while the Qatari index was not left out. It marked up about 0.95%, almost 1%. All right, now let's head on to Europe. Europe is sweltering under an historic heat wave, but Germans have their eyes on a coming winter already. They fear a lack for Russian gas supplies will mean energy shortages, and a new survey shows many already reducing their energy usage at this time. Let's hear more now from Rob Watts, right there in Berlin. Great to have you, Rob. So Germans are growing ever more concerned that Russia will not resume full gas deliveries. How are they reacting to that prospect?
Well, many Germans are doing their best to get into good habits and save on energy usage already. A survey for the DPA news agency found that almost 40% of people here are cutting back on their electricity, and of the rest of them, almost all say that they plan to do so in the future. Now, the sort of things that people are doing are, for example, taking shorter or colder showers, which perhaps isn't so bad in the current heat wave here in Europe, but also reducing the number of electric devices that they have on standby at any one time and checking for efficiency issues in their homes as well. Others are also choosing to do things like spend less time streaming things on their TVs. But again, like with the cold showers, that's something that's a little easier to do in the summer when you can be outside than in the winter. And there is a real fear here that we could be in the depths of a severe energy crisis by the time that the colder months do come around if Russia continues to throttle Germany's gas supply in retaliation for sanctions over the invasion of Ukraine.
And Europe's aviation industry is gathering for the biggest event in its calendar. What will the mood be like?
Well, this year's Farnborough Air Show in the UK, which alternates between Farnborough and Paris each year, comes against the backdrop of a travel industry in crisis in Europe. Airports and airlines are under enormous pressure because of surging demand and staff shortages. However, there is rather more optimism among aviation companies exhibiting at the air show than among airlines and airports, at least. Planemakers have a positive outlook because of the recovering numbers of people choosing to fly following the depths of the pandemic. That means more orders by airlines eventually. The war in Ukraine also means that governments are also increasing their defence budgets, and that means buying more military planes. As for commercial planes, Boeing is hoping to put to bed any residual bad feelings surrounding its 737 MAX jets this week, which you remember were grounded following two deadly crashes. It hopes to make orders worth $15 billion from the likes of Delta Airlines and Germany's Lufthansa during the course of the week. Some big plane deals also for European planemaker Airbus are set to be approved this week. So on what's potentially going to be the warmest day on record in the UK, things are at least hotting up for the aviation industry.
Right. Well, we'll keep tracking that event. But let's take a quick look at the markets now. How's the start of the week looking in Europe?
Well, this week investors will be paying a lot of attention to the value of the euro after it sunk below the US dollar for the first time in 20 years last week, albeit briefly. They'll also be looking at the European Central Bank, which oversees the euro, because the ECB is set to make its next interest rates decision on Thursday. A rates hike is looking all but certain, with inflation riding high across the region. Nerves over that are already casting a pall over markets on Monday, although Asian stocks received a bounce from a good end to last week on Wall Street. This week's also going to tell us whether Russia is going to resume gas flows through the Nord Stream 1 pipeline, which links it with Germany. That's due to happen on Thursday. We'll see whether those flows do indeed resume. Plus, there's also the uncertainty over the direction of the Italian government after Prime Minister Mario Draghi offered his resignation last week following the collapse of his coalition. So there are a lot of major market factors that will be decided during the course of this week, plus another round of corporate earnings. So there is plenty to keep an eye on European markets.
All right, so much for investors to look out for this week. Thank you so much. That's Rob Watt right there in Berlin. Let's head on to the UK now. We have Juliana standing by right there. Great to have you, Juliana. So it's interest rate season, but first off, let's take a look at what's happening with the extreme weather conditions in London. How's it looking right now?
Good afternoon, Laddie. Well, I've decided to stand outside on the street, which is a very silly decision to make because it is absolutely sweltering here. 35 degrees is the temperature I last saw when I left the office. And honestly, I can tell you it is very, very hot here. These are extreme weather conditions. I know if you're watching this from warmer parts of the world, you may think, well, what on earth is Britain getting its, underwear in a twist, but it's because we're just not used to these temperatures here. A national emergency has been declared for the first time ever. England has put out a red weather alert advising people not to travel, only if it is essential. We were expecting to beat the record today, which I believe is about 38.5 degrees, first recorded in 2019. The Met Office say that is not expected to happen. Perhaps there could be temperatures set to about 39 degrees, but definitely tomorrow 40 degrees is expected. We're expecting a disruption across all major rail networks. And just to repeat, the Met Office are advising people to stay at home and only travel if necessary.
Right. Thank you so much for coming out there for us, Juliana. But the Bank of England policymaker says interest rates could top about 2% in the next year. How are investors and analysts reacting to this?
Yeah, it's a really interesting point, actually. Michael Saunders, an outgoing a member of the Monetary Policy Committee of the Bank of England, has been speaking because we know that interest rates are a massive talking point, not just in the UK, but around the world. We're expecting inflation figures in this country on Wednesday. Inflation is currently running at a fresh 40-year high of 9.1%. That is expected to rise by the Office for National Statistics to about 9.2%. And all eyes are now on central bank governors. How are they going to try and abate this rise in inflation? You don't want too little too late or too much too soon. And that's what Michael Saunders is saying, that, observers should take it a little bit easy, that the Bank of England are watching the economy pretty closely to see if they need to move a little bit faster. Some are expecting them to do so. But if you look at how interest rates have risen so dramatically over the past few months, in December, it was at a record low of 0.1%, now at 1.25%. Michael Saunders predicts that that could rise to about 2% next year. But then it does have a knock-on impact. If you think of the millions of people who are on mortgage rates that do move with the level of interest rates, their mortgage payments every month have increased by hundreds of pounds, and it could go even further still. It's a huge talking point at the moment during the Conservative debate. Lots of Conservatives are tackling the Bank of England, asking them to do more. But I suppose we'll just have to wait and see what happens on Wednesday once we get that inflation figures, to see how the Bank of England decide to move when they meet next month.
Yeah, we'll be looking out for those figures as well. But UK house prices have risen for the sixth consecutive record, but it seems there are signs of a slowdown.
There are signs of a slowdown. Rightmove have released figures today, some eye-watering figures showing that the average cost of a property, just so you know, sorry, it is really hot at the moment. I'm sweating and shaking at the moment, laddie. It's £369,968. That is a record amount for prices in this country. One of the reasons why they have been moving so steadily over the past few months is because there is just very little supply at the moment, and I believe the pandemic and people working from home has triggered people to assess their working conditions. Everybody wants to have a decent Zoom background, don't they, laddie? So a lot of people have decided to move, and of course this has upended the property market. Landlords are trying to increase the amount that they're asking, but there are signs of a slowdown. One is because of the level of inflation, the fact that we are going through a cost of living crisis at the moment. People are now reflecting on whether or not it is a good time to buy. So we are expecting that house prices may slow down in the coming months, but it's still incredibly expensive, particularly for those who are trying to get on the ladder. So for first-time buyers, it's a really difficult time to buy.
All right, Juliana, thank you so much. You can go, get some cool now, and also try and drink lots of water there. Thank you so much, Juliana. All right, now, let's head on to Asia. We see Hong Kong's Hang Seng jumped more than 2%, leading gains in Asia-Pacific markets today, and all futures also rose by 2%. The benchmark index in Hong Kong was up about 2.7% to 20,846 points at the close. The Hang Seng Tech Index jumped about 3.02%, while Meton shares soared about 5.86%, and Longfor popped about 4.11%. Mainland China markets advanced. The Shanghai Composite was 1.55% higher at 3,278 points, and the Shenzhen component rose 0.98% to 12,532 points. Kospi climbed 1.9% to end the day at 2,375 points, and the Kasdaq was up 1.88% at 776.72 points. In Australia, the S&P ASX 200 rose 1.23% to close at 6,687 points, while MSCI's broadest index of Asia-Pacific shares outside Japan gained 1.8%. And U.S. stock index futures rose sharply as a busy week of earnings got underway. Futures contracts tied to the Dow Jones Industrial Average added about 300 points. The S&P 500 futures gained about 1.04%, while the Nasdaq 100 gained 1.24%. The major averages are coming off a losing week, despite a Friday relief rally that saw the Dow jump more than 650 points. The 30-stock benchmark shed 0.16% on the week, while the S&P 500 and the Nasdaq Composite fell 0.93% and 1.57%, respectively. Inflation jumped 9.1% in June, a hotter than expected reading and the largest increase since 1981, and in turn led traders to bet that the Fed could raise rates by a full percentage point at its meeting at the end of July. And oil prices extended gains propped up by a weaker dollar and tight supplies that offset concerns about recession and the prospect of widespread COVID-19 lockdowns in China, again reducing fuel demand. Brent crude futures for September rose $2.20 to $103.36 a barrel. U.S. West Texas Intermediate crude futures for August delivery gained $1.91 to $99.50 after rising by 1.9% in the previous session. The U.S. dollar retreated from multi-year highs, supporting prices of commodities ranging from gold to oil. A weaker dollar makes dollar-denominated commodities more affordable for holders of other currencies. And after the break, more stories on the African continent. Do stay with us. This is Business Incorporated. Welcome back. Now to our next conversation. Well, from COVID-19 pandemic and its health and economic impacts to the war in Ukraine, it's forced a global rethink of the current multilateral framework and what it means for the future. With rising global inflation and central bankers tightening rates, this impacts Africa and emerging economies negatively at a time Africa is looking to wealth creation. Let's have this conversation now with Mr. Olumide Emmanuel, founder, Common Sense Group. Join us right here. Great to have you on the program.
Yeah, thank you very much for having me.
Yeah, so with all these headwinds, global headwinds we're seeing right now, what do you think Africa should be doing, for wealth creation?
Thanks for having me and thanks for that question. I think the focus for Africa right now should be redefining the education of the continent. We have over 1.4 billion people on the continent, and the kind of education we have had before now has been the academic education that prepares people to go into the job market looking for a job. But the question we should be asking ourselves is, who will create the jobs for people to now go get the job? Because in the world of education, you are either educated, uneducated, or miseducated. And what we have had on the continent has been the miseducation of the populace. About 70% of people on the continent are below the age of 35. And they all go to school to come out and look for a job. So what we should be doing right now, because our greatest asset is the human capital, is to begin to re-educate the human capital of the continent on entrepreneurial education, so that they will be able to come into the marketplace to become solution providers, value providers, and use all the natural assets of the continent to boost the economy of the continent.
And some say, African cities are being built for wealth consumption, and not creation. What do you think about this?
Well, that's true. It's still all about the education because, we are still suffering from the colonial, I call it let me look for the right word, the colonial software that has been installed on the continent. Colonialism left us with a software that makes us to be dependent on the Western world. So a lot of people grow up with aspirations to have goods and products, clothes, all kinds of from the Western world. So we are more of consumers instead of producers. Now, the Creator created only one world, but we are called the third world nation, mostly because we consume more than we produce. And that needs to change. So when we change the educational formula for the continent, we will now create a new set of mindset, because there are toxic mindset that has kept us where we are. We have the nomadic mindset of people jumping from job to job, career to career, because they are confused and they are not staying in one career. We have the consumer mentality of just wanting to consume, because they don't realize that what you consume will diminish. We have that materialism mindset of everybody just wanting to be materialistic instead of being productive. We also have the entitlement mindset. So all this mindset, when they are removed, then we will be able to become a producer nation. And the more we produce, the more our export grows, the more we have more income, and the more the economy of Africa becomes better.
And global inflation doesn't seem to be peaking, at this point. How is Africa's real estate, doing as a hedge? How's that working as a hedge against inflation?
Well, real estate is a hedge against inflation and devaluation anywhere in the world, and Africa is not an exception. As a matter of fact, we have a better opportunity for that to happen. Because see, in real estate, everybody needs real estate. Everybody, 100% of people on earth need a place to live. So real estate is going to be forever required. Because I tell people, you don't wait to buy land, you buy land and wait. Because a city today was a village yesterday, and a village today will be a city tomorrow. So we are actually the emerging economy. We are the last frontier. And anyone that wants to see Africa become what Africa needs to be, we need to begin to think about redefining how we maximize the opportunity in the real estate sector. Look at what has happened in Dubai. Look at what's happening in other parts of the world. They've used real estate to be able to turn things around in the economy, and they added hospitality to it, and boom, Dubai is where it is today. So of course, real estate is one of the major vehicles of wealth creation and wealth retention that the continent need to give attention to.
And what other opportunities are you seeing, on the horizon for wealth creation?
So many opportunities on the continent. For instance, If you let's take ICT for instance. If you look at the US today, if we take about 4 or 5 companies in the US, from the eBay to the Microsoft to the Amazon to the Facebook, just put 5 of them together, you find out that their turnover per annum is more than the entire GDP of the entire African continent. Think about it for a while. Just 5 companies in America making more money than the entire African continent put together. That tells you the power in technology. But what are we doing? Our young people are out there, and a lot of the countries in Africa is not putting an enabling environment in place to maximize this. So we can look into the place of sports. Look at university system today. How many of the universities have a viable sports policy, sport platform to help people to harness their sporting gift? Look at entertainment. Most of what we have seen on the continent today as a result of entertainment has been by the sheer doggedness of the individuals and few corporate organizations that have supported them. When the countries in Africa understand the power of sport, the power of entertainment, the power of ICT, we're going to see a lot of change happening in the continent. We can go back to the issue of famine. We're talking of hunger, but we have so many lands that are left unused. And this is one of the things that we should begin to look at, because the opportunities are just there for us to explore.
Right. So much to unpack. There's so many opportunities. It's time to start taking advantage, of most of this to, enhance wealth creation in Africa. Thank you so much, Mr. Olumide Emmanuel, founder, Common Sense Group. Thank you for giving us some common sense there.
Thanks for having me.
Thank you. All right, now let's move on to other stories. Well, the Central African Republic has planned to leverage Bitcoin as a reserve asset as part of the country's efforts to embrace cryptocurrencies and blockchain technology as tools to bolster the economy. At this point, not looking too good. C.A.R's decision to deploy crypto's top coin as part of its national reserves come on the heels of a policy geared towards legalizing Bitcoin in the country. The nation became the first jurisdiction in Africa to approve Bitcoin as a legal tender back in April. While Bitcoin adoption in the Central African Republic Senate received support, the move has attracted criticism from external bodies who believe that the decision could jeopardize the nation's economic stability rather than save it. And Kenya's debt stock to China shot up by 10.8 billion shillings in May, the fastest month-on-month growth since January on the back of increased clearance of principal sums. Data from the National Treasury shows the loans increased to 796.5 billion shillings in May from 785.6 billion shillings in April. A jump is equivalent to more than half of the overall 18.88 billion shillings increase in Kenya's debt stock to China over the 5 months to May. China's stock has eased over the past 3 years, with World Bank and commercial sovereign bonds taking the huge bulk of the country's public debt. World Bank's lending through International Development Association grew by 20.6 billion shillings to 1.2 trillion shillings, being the largest creditor to Kenya. Borrowing through the International Sovereign Bond increased by about 6.85 billion shillings to 821.99 billion shillings. And Zimbabwe's central bank officials plan to meet retailers on Tuesday over price hikes. Bank's investigative arm, the Financial Intelligence Unit, will meet retailers and manufacturers to address price increases being slapped on consumer goods. The meeting comes against the backdrop of concerns that some firms are drawing funds from the central bank's weekly foreign exchange auction, but pegging prices to black market currency rates. That's helping to fuel extortionate price rises for consumers. After the meeting, an intensive blitz is planned by the FIU and police to identify and take legal measures against the culprits. And the South Africa's largest fuel producer, C.A.R, declared a force majeure in the supply of petroleum products due to delays in deliveries of crude to the Natref refinery which it owns. Total Energies leaving just a fraction of the country's fuel production capacity still operational. C.A.R said in a statement that Natref, one of a 180,000 barrel a day plant, was forced short after the late oil shipments, and C.A.R Oil will not be in a position to fully meet its commitments on the supply of all petroleum products from July 2022. The shutdown means the whole of the country's oil refinery fleet is out of action after a string of other facilities suspended production over the past 2 years. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.